Hi, and welcome to the Brown Financial Advisory 2025 Market Outlook. Thank you for joining me. I'm Scott McLeod with Brown Financial Advisory. Today we're going to talk a little bit about what happened in 2024, the economic outlook for 2025, and what the portfolio positioning looks like going forward. Just a few disclosures first, and then our agenda. So the first thing is to look at what happened in 2024, what contributed most to the performance, and look at the global markets. And then we'll move on to the economic outlook for 2025 across the globe and what we can expect in terms of global growth. And then finally, what the portfolio looks like right now and where we might find some opportunities and some risks in terms of performance. So let's start with the 2024 market. As you can see from the chart on the left, 2024 was a very good year in the market. You can see in the US market, stocks were up 25% for the year after being up 26% for 2023, which is outstanding performance. Those 2 years combined represent performance that we really haven't seen in the market in a very long time. International stocks, on the other hand, struggled, especially toward the end of the year because of a rising dollar, the appreciation of the US dollar. The international markets performed well, but a rising dollar causes a headwind for performance. And so the all-cap world ex-US index was only up about 6% for the year because the dollar was so strong after the election. So where did the 25% come from? Well, if you look at the chart on the right, you might not be surprised to learn the Magnificent Seven actually contributed the most to the performance of the US market for the second year in a row. In fact, the Magnificent Seven, the 7 technology companies that are some of the largest companies in the world, like Amazon and Facebook and Tesla and Google, for example, those companies contributed over 48% of their return. The return for the year was 48% and contributed over 55% of the S&P 500 return. In fact, what that means is that without the Magnificent Seven, the S&P 500 would only been up 10% for the year. If you look back in 2023, the same was true in 2023. In fact, the Magnificent Seven was up 76% in 2023, which represented 63% of the S&P 500 performance. So these few stocks have really outperformed the rest of the market and contributed significantly to the US market growth. When you look at the rest of the portfolio, the US bonds are actually lagging the market pretty significantly right now because of rising interest rates. So last year was a roller coaster ride in interest rates where they started lower, they rose in the early part of the year, fell in the middle of the year, and then rose again at the end of the year. So performance of the 2-year Treasury, for example, was pretty good at 3.79%. In fact, money markets were in the 4.5% to 5% range most of the year. But as you got longer maturities, those rising interest rates had a negative impact on performance. So 5-year maturities, for example, on the treasuries resulted in performance of only 1% per year. 10 years were actually negative. So when you saw the rising interest rates, it pulls back on the principal values of those bonds. But remember, you don't buy bonds for appreciation. You buy bonds for yield. And as the interest rates go up, you see higher yields across the portfolio. And those yields are still in the 4, sometimes 5, and even 6% range now going forward. And that's going to play an important role in the portfolio in the years to come. So where did that performance come from in the US and around the world? It's important to note exactly what was happening. And in 2023, you can see in the chart in the middle that the US stocks primarily, after 26%, the primary contribution to those the stock performance numbers was multiple expansion, which just basically means the stocks became more expensive relative to their underlying value. Earnings didn't really grow that fast, but the stock prices grew really fast. And what that meant was that multiples went up. So you hear PE ratios, for example, the PE ratios grew significantly in 2023. It wasn't exactly the same thing in 2024. Earnings did grow very fast, in fact, probably contributing upwards of 60% of the performance for 2024. But still 40% of that performance was, again, multiple expansion. The PE ratios continuing to rise and those stock prices becoming more and more expensive. Around the world, multiple expansion was really not a problem. If you look at Japan, the emerging market space, and Europe ex the UK, there was very, very little multiple expansion. In fact, the stocks really didn't become that much more expensive. So most of their growth was attributable to earnings growth. So earnings actually contributed and made those companies more valuable. And the only reason that their prices weren't higher was because the dollar being so much stronger, translating those more valuable companies through that more expensive dollar, meant that our experience in the US was not a lot of growth across the international space. So it was very much concentrated in the US. So let's look and see what happens now as we look forward in the outlook for the global economy. The first thing I would like to share with you is what's happening in the US. And there's a little bit of a dichotomy with regards to interest rates in the US. If you look at on the right side of this chart, you'll see that the US market is expecting something different than what the Federal Open Market Committee is suggesting. In fact, if you look at this chart, you will see the FOMC is actually saying over the next couple of years, interest rates will decline significantly from over 4 down into the 3% range, which would be a very significant result in our bond portfolio, and we would like to see that interest rate decline. But after the Trump administration was elected president, what you're going to see is that the market doesn't believe it. The market's actually saying, we think interest rates are going to be flat for the next few months, and the Fed even came out and said, they're going to be very careful about lowering interest rates because they're not sure what the Trump administration is going to do in terms of trying to stimulate the economy. Right now, they're trying to slow things down. So if they lower interest rates, they might add more fuel to the fire and inflation could rise again. So right now, we're in a little bit of a quandary as to whether or not rates will go up or rates will come down. But for the short term, it looks like they're likely to stay very much the same. If you look at the chart in the middle of the graph here, what you'll see is that the Federal Open Market Committee has a very muted view of what's expected to happen in the U.S. economy. In fact, 2024 grew at 2.5%, but we're expecting 2025 to only be 2.1% GDP growth and 2026 to slow to 2%. So they're expecting an economy that gradually slows down over the next couple of years. With a slowing economy, you would expect unemployment rates to also go up, and that's what the FOMC is predicting for the future as well. And the other thing is that they're expecting muted inflation. So right now, headline PCE is at about 2.4, and the core PCE is 2.8, but they're expecting 2025 to decline to 2.5, and then 2026 to be back down in the low 2s, 2.1, 2.2. So there's a little confusion as to what's going to happen. Will the economy be stimulated by the Trump administration and grow faster and result in higher inflation? Will the Fed be forced to raise interest rates? Is the market correct about the Fed remaining flat on interest rates? Or will we see the Fed continue to lower interest rates as they originally projected? And there's some uncertainty. And of course, the market doesn't like uncertainty. And so we have to kind of wait and see what happens next. Now, as far as the economy is concerned, right now there's a little bit of concern about the ability of the Trump administration to stimulate the economy, especially through tax decreases. And of course, taxes are a little bit of a headwind on the economy, but if the taxes remain low, then what we're likely to see is a more stimulative effect. So I think that we're likely to see some pushback on the extension of the Tax Cut and Jobs Act, which is set to sunset in 2025. We might see a little bit of pushback if they try to extend that beyond 2025 and into 2026 and further, because we're also expected to see the debt and the deficit to grow. And you can see here the federal net debt accumulated. If the FOMC, the Tax Cut and Job Acts, is extended, you would see this debt grow to 129% of GDP versus 119% of GDP through 2034 over the next 8 years. So this would be a significant increase in our federal debt. And then also in the deficit, you can see one of the other things is the interest outlay, how much we pay in interest payments on that debt. And if the tax cut extension goes through, you can see it rises significantly above the expected trend line over the next few years. So I think that may provide a little bit of headwind for some of the stimulative effects of lowering taxes from 2026 and forward. It doesn't mean that it's a bad idea to lower those taxes, but we've got to do some other things to compensate for how it may impact our economy and what may happen to our federal debt. Now, as far as global earnings and the outlook, you can see across various economies what the forward projections are for the next 12 months, and the U.S. looks incredibly strong. So we saw a little bit of a decline here, but the U.S. market is going straight up after this period. We saw a little bit of a decline in 2022, but the forecasts are basically straight up. A lot of this is projecting from what's happened in 2025, and the outlook is positive, but there's a little uncertainty around how much is that actually achievable, and a lot of that is pinned on that Magnificent Seven and what's likely to happen with those countries, or those companies rather. Now, the rest of the world has done very well as well. We've seen an increase in the outlook for China, the increase in the outlook for Japan and Europe, and particularly emerging markets. You can see Europe has really exploded, and emerging markets has seen a nice turnaround, but nothing like the U.S. and nothing like what we would expect to come out of the U.S. market. But there is one problem with what's happening in the U.S., and that's valuations. Valuations are very expensive in the U.S., and as you can see here, the last 25-year average, the U.S. market was here for 25 years. The current position is here after rising from 2024 here. And so this is an incredible increase up at the top of the range for the last 25 years. The rest of the world is trading at or below their long-term average valuations. And that just creates a little bit of a headwind for growth going forward in the international markets, in the US market as compared to the international markets. So what does that look like for the portfolio, and what can we expect going forward? The market right now is showing that bonds are really in a really fantastic place in terms of the opportunity. And what I mean by that is if you look at the chart on the left, you'll see something called yield to worst. So this is a bond portfolio, and it basically means what's the worst case scenario in terms of how these bonds mature and where they have been in the past. So the 10-year median is the line here, and you can see this is the median 10-year yield to worst on these bonds. In U.S. Treasuries, for example, the median range was 1.9%. Now it's 4.5. Investment grade corporates, which are here, you can see investment grade corporates over the last 10 years, yield to worst was 3.4. Now it's 5.3. The opportunities in bonds have increased significantly, and it's something we really haven't seen for the last 10 or 15 years because yields have now finally baked in. These higher interest rates over the last couple of years have baked in opportunities for the portfolio. Not only that, but as I've mentioned before, a decline in interest rates contributes significantly to the principal growth of these bonds as well. And the chart on the right illustrates this perfectly. If you look at the 5-year U.S. Treasury, for example, this 8% return is as a result of a 1% decline in interest rates. So this is just the increase in the yield and the principal value over the course of that decline. So it contributes significantly just with a small decline in interest rates. And the other part is how much risk is there of interest rates increasing? So the opposite is true. Well, what if the interest rates go up? Well, this chart illustrates it beautifully. If there's a 1% rise in interest rates, there's a slight decline on the 5-year, for example. It's 0, but if you look at 10 years, maybe 3.4. But the downside of 1% rise in interest rate versus the upside of 1% decline in interest rates is no comparison. The decline in interest rates significantly contributes to the performance, whereas the rise in interest rates only slightly decreases the performance. So the fixed income side of the portfolio right now is poised to do very well. If interest rates don't change, we're still expecting yields in the 5% range on corporates. If interest rates go down, you're likely to see performance in the 11% range. And if interest rates actually rise, we might see a decline slightly, but not as much as the performance of the portfolio. So bonds look like a great opportunity across the entire portfolio. Now, one thing that we are concerned about are valuations, and you've probably seen this chart before, but valuations are very expensive in the US. On the left-hand side, what you see is 1-year performance as it relates to the current forward price to earnings ratio. So right now, the US market is trading at 21.5 times earnings. This scatter plot basically says, if you start at this valuation, what's the next 12-month performance? Really no meaningful information in this chart because it's all over the place. But when you go to the chart on the right, you can see a very, very close correlation to what happens when the valuations are high versus what the expectation of performance might be over the next few years. And you can see here at December 31st of 2024, the price to earnings ratio was 21.5. When you see 21.5, it basically reduces the 5-year performance almost to 0. And this is historical. We see this in many examples in the S&P 500. Once it gets beyond a certain valuation, the outlook for the market is much, much less, and it's because it just doesn't have the room to grow. So basically what we're seeing, there's not a strong correlation. It's only a 20% correlation between those two factors. And there is one unique scenario in that much of the valuations are being driven by the Magnificent Seven. So those valuations are very, very high, whereas the rest of the market is actually not that much higher than average. So this chart, while it suggests that maybe the returns are muted, it really depends on how much those Magnificent Seven can really generate performance out of the earnings growth that they've seen lately. We'll see what happens with that over the next few months. Now, small cap equities, on the other hand, have really seen not much performance over the last few years, but are poised to do especially well. We like what's happening with small caps because if you look over the last few years, we've seen not great performance. So earnings growth, for example, in 22 was okay, 12%, but in 23 it was a negative 12%, and in 2024 forecasted also a negative 13%. A lot of that has to do with small companies that are not profitable. And if you look at the unprofitable companies in the US in this space, you can see that these periods of stress during the tech bubble, the financial crisis, COVID-19, and even the current situation coming off of 2022, a large percentage of small companies in the index are not profitable. For example, right now, 43% of the companies in the index are not profitable. But going forward, when you look and see what the projections are for 2025, it looks like there's a major turnaround coming in small company stocks. So the first quarter of 2025, we're expecting growth of only about 5%. But look, going forward, the second quarter is projected 50% earnings growth, 53% earnings growth in the third quarter, 53% earnings growth in the fourth quarter. There's quite a lot of opportunity in small company stocks, maybe because they've been beaten down, but it only takes a little bit of an improvement in the economics economic environment for the small company earnings to participate and to grow, and the projected for 2025 right now is a 44% increase in earnings. So the U.S. stocks have opportunities. Even though the large company stocks are pretty expensive, small company stocks have a nice opportunity for earnings growth throughout the U.S. Finally, this chart represents our best view of what's likely to happen in the market and in the portfolio over the next 5 to 10 years. The Brown Financial Advisory 5 to 10 year asset class and model return assumptions is basically a compilation of many of the major wealth management firms in the country, like JP Morgan, Fidelity, Vanguard, PIMCO, Capital Group, etc. Well, we take their economic data and we compile it into averages to give us a feel for what we should expect in terms of asset class performance over the next 5 to 10 years. And what these guys are saying is that we should expect taxable bonds, for example, to yield about 6% over the next 5 to 10 years. International stocks somewhere in the 7% range. U.S. large stocks somewhere in the 6% range, and real estate in the 6.4%. And we pile that in together into our model portfolio, our 60-40 allocation. We yield a portfolio that has a return of about 6.4%, and with their projections, an inflation rate of about 2.4%. So this is actually much higher performance on the portfolio than what we've built into our financial plans over the last few years, and actually about the same in terms of inflation. So the prospects going forward for the market and the portfolio actually look very good, and we're excited about what we expect to see over the next few years. Thank you very much for your time. We appreciate the opportunity to talk with you about what's happening in the portfolio and the markets. And I would just encourage you to be positive. It looks as though we may see some volatility this year, of course, with valuations high and the uncertainty around the new administration. But bear with it as the portfolio continues to plow through. We expect some good things out of bonds, good things out of small company stocks, and even the U.S. economy is expected to grow faster than much of the world. So stay optimistic. It looks like things are going well, and we look forward to seeing what happens next in the market. Please let us know if you have any questions, and we'll look forward to talking with you again soon.